Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and the regulatory landscape. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, as well as Maddie Radner, Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and Amy Zhang. She's Executive Vice President and Portfolio Manager at Alger. We're here to discuss how the macro environment is turning headwinds into tailwinds for mid-cap stocks and what themes look most attractive within that asset class. It's great to have all of you back with us. Welcome to Trade Talks. And Michael, set the scene for us in terms of what the macro environment looks like, what you're focused on.
Well, this week has been pretty quiet, but last week, of course, we got the CPI data, which is always a hot data release for everyone to watch, and it was a little bit hotter than expected, but overall pretty good. And I think the components that feed into PCE, which of course is what the Fed is going to watch, those were a bit better than what the actual CPI numbers. And so the kind of dialogue that you've gotten around it has been that some Fed officials, they're talking about maybe we should pause or they're open to a pause if the data, says that should happen, but that they don't want to make any predetermination. We have another month until the next meeting. So, it could have been a little bit better, but not bad news, not enough to derail where the Fed's headed.
It feels like everything's in a holding pattern for the next
Exactly.
few weeks here until we get more clarity on policy in general. Amy, it's interesting, you're seeing tailwinds for the mid-cap space. Now, we typically talk small caps or large cap names, not really as much the mid-cap space. Why are they turning into tailwinds?
Well, I think it's still very much under allocated, right? Like it's usually people have like barbell, small cap and large cap, but it's still under allocated by investors. And why it's interesting is because the valuation gap with the large cap is still pretty significant. Mid cap growth is trading at a 13% discount to S&P 500. Historically, like for the last 27 years, been trading on average about 13% premium. So that's a huge valuation gap. And also, I think mid-cap has always offered like the best of both worlds. Compared to small cap, it's higher financial quality because that stood the test of time and it's more liquid. But compared to large cap, still has a lot of discovery value. They are most of the mid caps are not very well followed compared to large caps, and the growth potential is generally greater, long runway for growth. So, and also for the last 30 years, mid cap growth as an asset class has better returns than large S&P 500 and also small cap growth.
Speaking of small caps, Maddie, anything happening in this space?
Well, I think it's a great day for us to be focusing on the small cap, mid cap space because small caps are really breaking out above July highs. We're seeing the Russell 2000 really maybe approaching highs from November of 2021 now. Everyone's looking at those levels. Over the past few months, the small cap space has really been stuck in a consolidation range as investors really question rate cuts and the likelihood of a soft landing. So I think now that the growth outlook is improving and there's more visibility on rate cuts, we could continue to see small caps being supported. That said, one rate cut might not solve all of their problems. A lot of smaller caps, as opposed to mid caps, do have a lot of refinancing risk still out there, and half of the debt that they're holding is short-term or floating rate. So it might take a few more cuts for them to really see a larger bounce.
Yeah, and Chris, from your perspective?
Yep. So I agree with Amy, the mid-cap 400, so we'll talk about the S&P and the drill downs because that's kind of a little bit more where this conversation is going as opposed to the Russell where, 40% of the companies that are cash burn, to Maddie's point. The mid-cap's making, trading almost at all-time highs. The S&P 600 is not that far away from the 2021 highs either, yet you still hear all the conversation about the 500. And even with yesterday's sell-off being led by chip and tech stocks for the most part decelerating, you're starting to see a lot of companies starting to kind of pull through this, what would be the best word, financial instability that you've been created in the post-COVID era, especially with inflation and the fear of a softening labor market. Now, if you look at overall, the labor market's actually pretty good. You're seeing wage growth outpacing inflation, to your point, and you're seeing people spend. Now, the lower income is still suffering a bit, and that's impacting a fair amount of the companies. But the early report and what I'm hearing from some of the issuers here on the consumer side and the retail side is that they're cautiously optimistic. Consumers are more concerned with value and quality as opposed to buying, yet we still have Q4 to see what happens with the Christmas season, even though we're polling earlier with another Prime Day, just finishing. We'll see how that pulls out. But the mid cap is doing okay. I don't like the performance as much. S&P 400 retail, consumer discretionary, and consumer staples are all trading flat to lower for the month so far, not participating in a larger rally yet, which means that there is room to grow in those smaller names. And again, some of those small names are not really that small. 8, 10, $12 billion companies are not small companies at all.
Yeah, well, what's interesting is Amy, in the mid-cap space in particular, there are specific themes. It is more of a stock picker space. Some of those themes are either idiosyncratic to those companies or to subsectors within sectors. So what do you like there from a thematic perspective in mid-caps?
Yeah, that's a great question, because I think, for us, I run 2 mid-cap strategies, and we're very early to be indexed to AI, right? So it's not just, NVIDIA, since, we cannot buy NVIDIA from a strategy point of view. However, we think, for example, data center is a very critical part of the AI infrastructure. So we were very early investor of Vertiv, right? So clearly Vertiv has done exceedingly well. And then, they do the cooling and power management for data centers. And then we also we invest in, Constellation Energy. That was way before you all heard the repowering the 3 Mile Island of Microsoft, right? And that's that I think that's a strong, very strong secular trend is electricity demand is increasing, and the desire for hyperscalers to power their data centers using clean energy, carbon-free, is tremendous, right? You saw Google announcement, right? Amazon, right? So that's a very strong secular trend. And both companies, they have something in common, is that they both generate massive cash flow, right? From a PE point of view, and their EPS is growing much stronger than revenue, and that also with the pretty strong, high quality revenue growth. And they also great capital allocators, buying back shares and also paying down debt and so forth. So it's very strong financial quality, and there's a lot of growth still not priced in.
Yeah, and that's something that we don't necessarily always see with the small cap space, where perhaps the balance sheets aren't as clean or they're not generating as much cash. So this seems to be the sweet spot between having a clean balance sheet, a business that's in demand, and attractive valuation. Yeah,
exactly. So well said. It definitely a sweet spot, is a very compelling, and also it's still very underallocated. So I think that should actually, it's sort of the best hidden gem, so to speak.
Yeah, it certainly is. Maddie, let's talk about more forward-looking, in terms of the risk-on sense. Anything in the IPO market, right? Yeah. Or is it another one of those spaces where it's going to be a little bit quiet till we kind of get some clarity?
Yeah, I think we're going to continue to see a gradual reopening, and then really in 2025 is where the IPO market will pick back up. So far this year, there's been 179 IPOs across the U.S. exchanges that have raised $34 billion in proceeds, compared to last year when we saw 158 total IPOs that raised $23 billion in proceeds. To your point, there are a few themes that we are noticing either in the pipeline or in recent months, and one of those themes is the appetite for biotech IPOs is slowly coming back. I think that risk appetite is slowly coming back. So far, there's been 20 biotech IPOs this year, which is in line with levels we saw last year and the year before. Obviously, in 2021, we saw over 100 biotech IPOs come to market, so we're not going to get there yet. But actually, in September, there were 8 healthcare IPOs, which is the most since November of 2021. So that appetite for healthcare and biotech is coming back, and I think part of it could do with the election. Companies are trying to get out before some of the pricing policy noise comes into play, but it also might be encouraging for other companies who are maybe waiting to see these biotechs come out and perform pretty well.
Yeah. Speaking of policy for a moment here, Michael, if you have to weigh between Fed policy and fiscal policy, when you're speaking to clients on the street, what are they more concerned about? We seem to hear that fiscal policy is really the concern here.
Yeah, I think in the short term,
right,
it's the Fed rates, but in the long term, it is the fiscal policy, because that's where you think about what does that mean for rates in the long run if we're running 7% deficits or 9% deficits that you're hearing estimates for the coming years? And what does that mean when those are the kinds of deficits that you see during deep recessions instead of the economy's doing pretty well? So that's where it's kind of a short-term versus long-term perspective that we see talking to clients where, what does that mean for rates? Because those types of deficits, that's going to require a lot more borrowing from the government, and you could see more risk premium going into that kind of the rates that the government is able to borrow at. So it has definite implications for long-term borrowing costs.
Yeah, it seems as if we've seen a number of dichotomies over the past 5 to 6 years where sort of the inverse of what you would expect to happen from a historical perspective is taking place. Chris, when you're talking to issuers, and of course when you think about what corporate tax policy is going to look like, are they being challenged at all in terms of thinking about longer term strategy? Have you heard anything like that yet?
Not yet, not as much. What we're hearing more so is people are more concerned, to Maddie's point, of refinancing their debt from the high nominal rate. And 5.25%, 5.5%, or even more, a lot of the small cap companies that are cash burn, they need to raise $10 million to cover 2 years worth of expenses. That's coming at a very steep price, 25, 30% plus probably a warrant attached to it if they're doing a pipe. So they're very happy with this projection, but it's still not yet. It's going to take 6 months to a year for these rate cuts to trickle through. And with that, the companies are optimistic, but they've been doing a one-year refinance, and trying to get to this point. Next year, we'll start to see it a little bit better. To Michael's point, fiscal policy, the two major candidates are throwing everything they can at the wall to try to find that middle ground of the 4 to 8% voters that are going to swing it for either one of them. And from a business perspective, and to Michael's point as well, the economy is doing pretty well, right? Employment's pretty good, but our debt keeps rising. There is going to be payback for that somewhere down the road. But in the near term, we're looking at the IPO market, and really we're probably thinking Q2 next year of more of a ramp up with the deal roadshows. We want to get through this year. We want to see what the policy rates cuts look like. Like you said before, Bostic even said that they may not be. He's open to not cutting in November. Yet Fed Fund futures are following right along with the set plot at 2 quarter-point cuts for the rest of this year. Data dependent as always, and we'll see what happens. But the issuers are not as concerned. They are planned out with strategy. But again, on the consumer side, the strategy is to quality, cater to spend, and hopefully capture some of that spend. Even if you even look at some of on the consumers, I never talk about. I also cover the restaurants here as well. The QSRs are they're doing okay, but not great because that trade down is just not there for a lot of folks. Consumers, and if you listen to a lot of the earnings calls with the banks, consumer borrowing is solid, but that money is being spent on staples and cooking at home as opposed to going out lately.
Yeah.
So there's a lot of mixed signals there. I think the next 2 quarters are going to be very, very challenging. One, we're going to figure out who wins this election and move on from there. And 2, as long as the Fed is happy with the data, those rate cuts will continue, and that'll be good for the markets on all sectors, small, mid-cap, and large.
Amy, what are you hearing from clients? Are you advising, stay in the long game, don't be so married to exactly what's happening, with the election? Or is that impacting your strategy, in other words?
Well, I agree with Maddie that I think small cap probably has the biggest bounce, right? And also for us, we've always, in other strategies that I manage, that we always, focus on strong balance sheet companies. So we don't have so we sort of have the best of both worlds. Like we're long duration by nature, driven by innovation, but we have strong balance sheets, so we don't have those refinancing risk, right? And so to that extent, and especially healthcare, like biotech. So there's definitely more interest, a lot more interest. But I think that people still want to wait till the election. Just it's sort of like, I think just sentiment. But a lot more interest from small and mid as well. So I think growth strategies other than mega cap, because generally increasing demand for calls and meetings and so forth. I think people want to be prepared, and I do believe we're going to enter the golden age of small cap again, right? I mean, I do think it's going to beginning of a new cycle, but I think all we need is just for the headwind to turn into tailwind. So for us, actually, how much they cut, like whether it's 25 basis or even no cut, as long as we don't have the rapid, rate hikes again, which I don't think will happen over time. It may take like several months or or even 6 months plus, but I think we will see the bounce, especially like for healthcare. Healthcare has been the worst performing sector in small cap growth, right? And a biotech, including biotech, and usually healthcare and biotech, they do well in a slowdown. So if we have a slowdown, well, if in a big recession, everything goes down. But if we have a mild recession, which is more likely, if we just muddle through, have a slowdown, then I think biotech will outperform.
Yeah, well, and that's what's so great about your space, because it is that classical stock picking that it brings to the table, right? It's not like, all what is it, all boats rise with the tide, whatever the expression is, but there really is that stock picking mentality there.
Yeah, absolutely, because as long as we don't have, it's hard in the last 3 years for small cap, because you're really swimming against the current, so to speak, right? And the small cap takes time to work out. So some of them worked out, but a lot of them still take time. And the mid cap, given the sort of asset class, mid cap came back. Our mid cap strategy came out very strong. Just it's a day and night between from now and then like a year ago. But I think small cap will follow suit. But you're absolutely right. That's why I love the small mid cap space, because you can really generate outsized alpha by picking stocks and being early, right? For example,
I mean, the Constellation call.
Yeah, and also Vertiv, right? We're very early in Vertiv, and also App 11. That's another one. The marketing, AI platform using, a marketing advertising platform using AI.
Yeah,
and
they're not so mid cap anymore.
Yeah.
App 11, right? They're more large cap companies.
Exactly. Now. So sometimes when things work out, I think it worked out very quickly. The founder CEO we met in our office as well. The visionary, and their numbers are just really low, and their engine, it's a recommendation engine using, they do better than anybody else in terms of monetizing inventory, and then they focus on the mobile gaming, but now they go on e-commerce, so it's like tremendous growth potential.
Yep. Leveraging that predictive technology.
Yeah, exactly.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.